We're jumping straight into Astera Labs today. Everyone is watching the price action, but the real story is the AI connectivity bottleneck. I mean, just look at what happened. We saw the stock close at roughly $170, 169.85 to be exact, on February 6th. That's up over 16% in a single day.
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us. And my job today is to, simplify why a company that makes interconnects, which sounds incredibly boring, is suddenly the hottest ticket in town.
And before we get into the plumbing of the AI revolution, do us a huge favor, subscribe and hit the like button. It really helps us keep these breakdowns coming. Now, let's talk about this breakout, hitting new 52-week highs right before a major event. So the big question is this just hype, or is the infrastructure of AI finally getting paid?
Well, it's the classic pick and shovel argument, but with a serious high-tech twist. Investors are piling in because the numbers are starting to back up the story. It's not just a concept anymore. The market's realizing that, you can buy all the GPUs you want, but if you can't connect them efficiently, you just bought a very expensive space heater.
That's the bottleneck we're talking about. But before we get to the physics of it, I want to stick on the numbers for a minute because they are frankly shocking. The revenue trajectory growth feels like an understatement. It's pure acceleration. It's like a vertical line on the chart.
It is. If you look at the progression, it just tells the whole story of the AI boom right there.
Okay, so let's track this. Q1 of 2025, they were sitting at $490 million. Pretty good.
Impressive, yeah.
Then Q2 comes around and they jump to $606 million. But
Boom,
then,
here it comes.
boom, Q3 hits $723 million. That is a massive 71.3% yearly growth rate.
And that velocity is key. Usually, as companies get bigger, that percentage growth slows down. It's the law of large numbers. But Astera is accelerating as they get larger. That tells you demand is just stripping supply. The hyperscalers, your Amazons, Googles, Microsofts of the world, they are desperate for this hardware.
And here's the kicker, and honestly, this is what caught my eye more than the revenue. It's the bottom line. This is not one of those burn cash to grow stories we saw, in the dot-com bubble or with some early software companies. They are printing money.
That's the differentiator right there. They posted $199 million in net earnings for Q3. That's a 27.5% net margin.
Which is just wild for hardware. Usually hardware is a low-margin game. But 27%? That screams pricing power. They are charging a premium, and customers are paying it with a smile on their face.
Because they have no choice. And that brings us to the why. Why is this so indispensable? We threw around the word interconnects earlier, but we should probably break that down. If I'm a generalist investor, why do I care about a wire?
Yeah, explain that. Because in my head, a wire is a wire. I can go to Best Buy and get a cable for $10. Why are these guys making billions off of it?
Okay, so it comes down to physics. Think of a modern data center like a massive, sprawling city. The hyperscalers have built these incredible skyscrapers. Those are the GPUs, the super-fast chips from NVIDIA or AMD. These chips are processing information at, just lightning speeds.
Okay, so the skyscrapers are the brains. Got it.
Exactly. But here's the problem. The roads between those skyscrapers are old country roads. There are copper wires. When you try to move data at the speeds AI requires, we're talking massive throughput, the electricity faces resistance.
It's like trying to drive a Formula One car on a gravel driveway.
It's even worse. It's like the road just disappears. Over a long enough copper wire, the signal literally fades away. It just turns into static. If the data doesn't get to the chip fast enough, or if it arrives corrupted, that expensive NVIDIA chip just sits there, idle. It's waiting for instructions.
And that's the cash incinerator scenario you hear about. If I spend $1 billion on a GPU cluster and it runs at 50% efficiency because my wires are too slow, I'm effectively setting $500 million on fire.
Precisely. That is the ROI calculation these companies are making. Astera Labs sells the retimer. Think of a retimer like a relay runner or a pit stop. As the data travels over the wire and starts to get tired or degrade, the Astera chip catches it, cleans up the signal, boosts it back to full strength, and sends it sprinting to the next checkpoint.
So they basically defy the physics of resistance.
They manage it. They allow copper cables to work over longer distances and at higher speeds than they naturally should That's the Scorpio X series you see mentioned in the reports. It's their new line of connectivity switches designed for rack scale AI.
Rack scale. So we're not just connecting two chips next to each other. We're talking about managing how entire towering racks of servers talk to each other.
Correct. And they validated this at CES 2026. They showed the world that they are way ahead of the competition in managing these massive, complex clusters. And because they have this proprietary IP, they have a moat.
And that mode is built on fear, right?
In a way, yes. Fear of failure. If you are a data center operator, are you really going to save a few pennies on a generic retimer when the risk is crashing your entire AI training run?
No way. The switching costs are way too high. It's like you don't skimp on the brakes of a Formula One car. You buy the best, period.
Exactly. You pay the toll to Astera Labs so your highway runs at full speed.
Okay, let's shift back to the financials for a second because I want to geek out on the balance sheet. As a value guy at heart, I usually hate these high-growth tech stocks because their balance sheets are a mess. They have debt, convertible notes, all sorts of weird financing. But Astera looks pristine.
It's a fortress.
I'm seeing a current ratio of 12.8. Now, for our listeners, a current ratio covers your ability to pay short-term debts. Anything over 2 is considered safe. 12.8 is practically showing off.
And the zero long-term debt is the real kicker. In this macro environment with rates all over the place, having no debt gives you incredible flexibility. You aren't beholden to bankers.
And it lets them fund their own growth. They spent $267 million on R&D in Q3 alone. Usually, a company growing this fast has to issue more shares, dilute the shareholders, and go back to the market to beg for cash to build the next product. Astera is paying for it out of their own pocket.
That is the self-funding flywheel. Revenue drives profits, profits fund R&D, R&D creates better products, which drives more revenue. It avoids dilution, which investors love. You get all that growth without your slice of the pie getting smaller.
And Wall Street is clearly noticing. We saw JP Morgan slap a $215 price target on the stock? Considering we're trading around 170, that suggests there is still plenty of room to run.
It does. But,
Yeah.
and there's always a but on this show. We have to be the adults in the room.
I hate being the adult, but you're right. It's so easy to get swept up in the green arrows and the 16% days. We have to look at the flip side. Let's unpack the risks, because when a stock goes vertical like this, the air gets very thin.
It really does. And the first thing, the most obvious thing, is valuation. This stock is rich. There's just no getting around it.
Rich is a polite way of putting it. I mean, we are looking at forward PE ratios estimated somewhere between, 76 and 128, depending on whose estimates you use. That is nosebleed territory.
That is the danger zone. When you are priced for perfection, you have to execute perfectly. Every single quarter. If they miss earnings by a penny, or if their guidance is just good instead of spectacular, this stock could drop 20% overnight. The market's expectation is effectively infinite growth.
We've all seen that movie before. And there's another yellow flag I spotted, the insider selling. In the last 3 months, insiders have sold about $87 million worth of stock.
And this is the top brass, right?
Yeah. Back in November, the CEO and the COO each sold about 90,000 shares. Now, I know the standard defense. Executives sell for many reasons, but they only buy for one. Maybe they're buying a yacht or paying a tax bill or something.
True. Tax planning, diversification. I mean, these people have the vast majority of their net worth tied up in one stock. It's prudent to sell some, but it does temper the excitement a bit. If the people running the company are taking chips off the table at these prices, should you be aggressively buying? It suggests they think the price is, fair or maybe even full.
It's a valid question. Although, to be fair, looking at the institutional ownership, it's still high around 60.5%. So the big money, the pensions, the hedge funds, they aren't fleeing. But the bosses are trimming.
There is another technical detail that bears watching, and it connects back to that hardware discussion. The gross margin. We mentioned the net margin is great, but the gross margin actually dips slightly to roughly 75%.
Yeah, and 75% is still fantastic for a hardware company. But why the dip? Is it competition? Are they lowering prices?
Not exactly. It comes down to product mix.
Yeah.
They're selling more of that Taurus hardware. That line helps with the rack scale connection, but it has slightly lower profit margins than their legacy chips.
So it's a mix issue.
It's a mix issue. As they scale that product up and become more of a system seller rather than just a component seller, they might make less money per unit on a percentage basis. It's called margin compression.
And if Wall Street decides they are a hardware box seller instead of a magical AI enabler that multiple contracts, A hardware company might trade at 20 times earnings. Astera is trading at over 100 times. That gap is the risk.
Precisely. You are paying for software-like margins, but the business model is drifting slightly toward hardware economics. That is a crucial nuance.
You're selling more, but keeping a little less of every dollar. And let's not forget the volatility. Before this massive 16% pop on February 6th, the stock was actually underperforming the sector. It was down nearly 20% over a 6-month period.
That's the reality of these high-growth names. It is a bumpy ride. You have to have the stomach for 20% drawdowns if you want to catch the 70% upswings. It shakes out the weak hands.
So, okay, let's talk about the future. What are we watching?
The immediate catalyst is right in front of us. February 10th, 2026. After the bell.
Mark your calendars. 4:30 p.m. Eastern, that's the Q4 earnings call. Expectations are set. Wall Street wants to see 51 cents in earnings per share and about $250 million in revenue.
But here's the thing about expectations. There's the official number, the 51 cents, and then there's the whisper number.
Right, the number the traders are actually betting on.
Exactly. And given their history, the whisper is likely higher. In Q3, they had a huge beat, 49 cents, versus an expected 39. The market is betting on another surprise. If they just meet the 51 cents, the stock might actually sell off.
The classic, buy the rumor, sell the news. They need to crush it to justify this price.
We also have to connect this to the bigger picture. Look at TSMC, Taiwan Semiconductor. They just posted a beat.
And since TSMC makes the chips for, well, basically everyone, including NVIDIA and Astera, that usually signals that the whole ecosystem is healthy.
If the factory is busy, the people selling the plumbing for the factory are likely busy too, plus the macro environment is shifting. Rate cut expectations are helping growth stocks like this. When rates go down, future earnings are worth more today. It's a bit of a tailwind.
Also, watch for news on that scale-up switching momentum. There was a lot of chatter at the Needham conference. If on the earnings call they announce new partnerships or faster adoption of that switching tech, that could be the fuel for the next leg up.
Agreed. Guidance will matter more than the past quarter's results. We need to hear them say that demand is accelerating into 2027.
So let's wrap this up. We've covered a lot of ground. We've got a stock that just broke out, a massive earnings call in a few days, and a business that is, literally the plumbing for the biggest tech trend of our lifetime.
And we have a valuation that demands perfection.
So my takeaway, this feels like a high conviction bull case. I'd give it a 9 out of 10, but, and this is a big but, it requires a stomach for that volatility.
I agree with a 9 out of 10 on the fundamentals. The business is real, the profits are real, but maybe a 6 out of 10 on safety.
Yeah.
The only thing that's speculative is the multiple investors are willing to pay for it.
That's fair. If the market sneezes, high PE stocks catch a cold. But look, Astera Labs isn't just riding the AI wave. They are building the canal the wave flows through. That is a powerful position to be in.
And with a debt-free balance sheet, they can weather a storm if one comes. The demand from hyperscalers does not seem to be slowing down anytime soon.
That's the lowdown. Watch that February 10th earnings report like a hawk, specifically that 51-cent EPS target and the forward guidance on margins. That is going to be the deciding factor for the next leg up. Thanks for tuning in to the Easy Money Show.
Stay curious, and we'll see you in the next one.
Don't forget to like and subscribe. Catch you later.